I bet no loan officer has ever told you this. If you are self-employed, or you have non-traditional income, or you're a 1099 employee or a company owner, you need to talk to a mortgage professional 2 years before you buy a home. Like, seriously, if you're thinking about buying a home in less than 2 years, you need to have that conversation today. Stop this video and dial my number and let's talk. Why, Michael? Why has nobody told me this and acted as urgent as you are acting right now? Well, they don't want to scare you, and I don't blame them for wanting to scare you. But there is a lot as a self-employed individual or an independent contractor you can do knowingly or unknowingly to benefit or hurt yourself in the home buying process. There are literally things that you could be doing today that would help you buy a house in 2 years, and there are things that you may be doing today that will keep you from being able to buy a house this year or next year or even 2 years from now. Well, I don't understand that. Why is it different for me than for a W-2 employee? Well, that's a great question. Remember, Underwriters and Fannie Mae, Freddie Mac, all the agencies, FHA, VA, all they care about is your ability to repay your mortgage. In order to determine whether or not you have that ability, they want to see predictable income. Predictable income is defined differently depending on how you are paid. For instance, if you're a school teacher and you get a W-2, they feel really good that your income is predictable. If you are a banker and you work at the front counter and you get paid hourly and you work 40 hours every week, they feel really good that your income is predictable. But if you're self-employed and you own a company, well, there's a lot of uncertainty there. If you're a 1099 employee or a contract laborer, we might call those, you're still self-employed and there's a lot of uncertainty there. So if any of these things are true, if you're outside of a normal, and by the way, even if you own the company but you pay yourself a W-2, it's still different. If you own the company, you can trick the system in your W-2. But if you don't own the company, your W-2 is going to be realistic and it's not going to be something that you can manipulate. What do you mean, Michael? How could I manipulate it? Well, I'm a company owner. I own Weber Mortgage. If tomorrow I wanted to increase my pay by 50% to qualify for a house and then 45 days from now lower it back to my current pay, I can do that. I'm the boss. I do payroll. If you're self-employed, you can do the same thing. Fannie Mae, Freddie Mac, HUD, they all know that. So they know you have the ability to game the system. So how can they get around that? How can they ensure themselves that you're not gaming the system? They do it by looking at a bigger time picture of your income. They're looking at your income over a 2-year period as recorded in your tax returns. Not a 2-year period, a 2-year period as recorded in your tax returns. Tax returns are the one thing you cannot manipulate after they're done. You could go in and amend them. Yes, there are tricks that you could do. But for the most part, whatever you filed on your last 2 tax returns is going to be an accurate assessment of your income. There's several ways that your tax returns might look different. For instance, what if you went from paying yourself $100,000 to $200,000 a year? Are we going to be able to qualify you on $200,000? Remember, we already said there's no guarantee. You won't knock yourself right back down to $100,000. So 2 years of increasing income, we need to average. But what if you were paying yourself $200,000 and now you're only paying yourself $100,000? Well, now that's a red flag, because now are we even going to average that income? No. Now we're going to assume you're going to pay yourself $100,000. These are Fannie Mae, Freddie Mac, HUD, VA, and USDA guidelines. These aren't Weber Mortgage or your local bank. These rules are set up ahead of time, and they're set up to make sure you don't game the system. So I tell you all that to give you specific examples of why it is never, ever too early to have a conversation with a loan officer about your particular situation when you are self-employed. And by the way, please, whatever you do, do not wait until you're ready to buy a home to have this conversation. If you do, it's going to be a challenge at best, frustrating probably, and potentially a no-go. We might have to tell you no because of the documents that you filed and you can't easily correct. If you call me today and you say, hey, Michael, I want to buy a house late this year, or better yet, next year, or maybe even I've got a 3-year-old and when he turns 5, I want to buy a new house to move to a school system. That's going to be 2 years from now. If you call and have those conversations with me now, I can coach you in everything you need to know about how underwriting is going to look at your income, and you can make decisions about income and taxes that you pay, not based on trying to pay the fewest amount of taxes, which we all want to do as business owners, but more importantly, on qualifying for the house that you want to buy to the benefit of your family. So please, please listen to what I'm telling you. If you own your own company, if you are not a W-2 wage earner, you are paid 1099. If you are paid cash under the table, if you are a contract employee, call me today, even if you don't intend to buy a house in the next 2 years. Let me educate you on what they're going to look at so that when you change your mind and decide it's time to buy a house, you've already been acting in a way that supports your end goal in housing. It's complicated. It needs a phone call. It may need a face-to-face conversation. It definitely includes me reviewing your tax returns because I need to be able to tell you what you're doing. By the way, your CPA is not filing tax returns that are going to be beneficial to you buying a house. Their goal, because you want them to, is to minimize your tax debt. So they're going to file tax returns that show the least amount of income possible. And when you're ready to buy a $700,000 house or a $300,000 house or a $2 million house, your tax returns may not show enough income to do so. So please, if you haven't heard anything else I say, understand this. You need to have a conversation with a loan officer. One last thing, please don't have a conversation with a brand new loan officer or someone on the phone that's called you because you're an internet lead. Talk to a professional who's been in the business 20 plus years, who works with a lot of self-employed borrowers, who knows what they're doing and has a reputation for delivering an exceptional experience. I can tell you we fit into that. There are others out there who do too, but don't just call your nephew because he's been a loan officer for 6 months. And don't do business with your best friend because they're your best friend. Do business with someone who understands what they are doing. As a self-employed person, you have unique needs. If you have questions, and you should, pick up the phone and give me a call.